This conference will now be recorded.
All right, let's see if this works. Okay, so I talked a little bit last week about how to use dailies and weeklies. So we're going to try to see if this will not explode my machine. Okay, so first things first, if we're talking weeklies, right? This is in the bottom right-hand corner of the chart. This is the DMZ. This is what I like to use to kind of ascertain the primary trend of things. And so if I'm ever looking at anything that I'm considering trading, specifically especially the indices, and I should probably qualify this to say most of this stuff I like to trade liquid stocks. So like you'll see this radar list is the S&P 100. What I like to use and you know if you're position trading, which would be what you would want to do, like if you're in a bull market. When I say position trading, you're going to take a position, you're going to hold it for a couple weeks. You know, oftentimes people will say, well, what they'll want to do is buy dips on the at the bottom, and that's fine. You can try to do that, but you have much more success if you just ride the trend and catch the meat of the move, which is what DMZ will do. So I marked here with green and red when DMZ flips up and the DMZ diffs are positive, and when it flips down and then negative. So you would have missed the whole bear market, right? And it's been pretty good even back to the 1960s on the S&P. So if you trade it this way, you'll beat buy and hold. But the only caveat is that when you're long, you should use some leverage to be long. You don't want to just do a regular SPY. You want to buy something like a 2x, or I think they even have, you could do it any way you want. But what I like to do is either use 2x, 3x, or some combination of that to get anywhere between 1 and 2 times leverage. That's typically what I would do for my long-term accounts. So you can trade this, and the drawdowns are pretty reasonable on it as well. So like if we scoot back and look at what 08 looked like, right? 08, here's 08. It was out way back in 07 in July, and it didn't get back in until May of 09. Pretty good. Pretty good. So it's not rocket science. It'll carry the primary trend up here, gets out, and goes back in. So just kind of showing here the last few years, ins and outs, in and out. Here's COVID. This is one time it did take a little bit of a drawdown here because COVID was so fast. It's a slower turn, but that was pretty much an anomaly there. 87 would have been the same kind of way. But if you make a big top, they're typically made over time, and they round. Like this one's is a big top. So I like to trade. That's what I like to do. So like if I set up a radar screen, I'll put the S&P 100 in it. I'll add the DMZ diffs on the weeklies, and then I just filter it for anything over 0. So like what are some decent candidates for trading? And you might say, well, I want to go to the one that's like the best, Netflix, right? So I'm going to go trade that. And that's a strong stock right now, doing really well off the bottom. These are the June lows right here. And it's up almost 100%, right? And you say, well, it's a pretty big bounce. So that's a stock that you know is very strong. One thing you do gotta be a little bit careful with is when the DMZ diffs get really high, like you're up around 36. Oftentimes it can mean we top out and go sideways for a while, or just top out and roll back over. That's not the case here anyway. If the DMZ diffs are greater than 0 and green, that just means it's going up. So these are all candidates to trade. What's this? BlackRock, BA, Lockheed Martin. Lockheed Martin, I think, is making 52-week highs. A lot of times people don't want to buy strength like this, but it's kicking butt. So what I like to do, though, is go look at the low end just over zero, like Philip Morris this week, if it closes down here and starts to go up, this is a candidate right here to start a long, because look at this nice base. It's trying to break up, out, and go up. That's what it's trying to do. So that's something that you can consider, and your stop is super simple. So you can imagine you're back here and you go, oh, I bought it here. Oh, I had to sit through this, but you're not stopped out because it didn't go less than zero yet. Still 0.43 here. And you rode the trend all the way up here. So you got to get in down there, you're out up here. So that's the idea with taking trades like this. And the caveat with something like this is it works a whole lot better if the index is in a bull market, right? So you want to be doing this kind of stuff when this is green. I'm very wary about taking position trades and stuff like that when the indices are still in a bear market, because there's a long time to hold. Your stops have to be wider, position smaller, stuff like that. Okay, so that's DMZ on the weekly. So if you got some candidates here where the DMZ on the weekly is good, let's just pick one. I don't know. Let's pick one that's been in there, uptrend for a little bit. I don't know, BA. BA is doing okay. Oh, doing really good today. So now we're on to what I like to do to trend follow for the dailies. So this is a daily chart, not a weekly. It's a daily, it's BA. And you can use the CI to trend follow on the dailies. So you're in around here. And when I say you're just buying the cross of this blue line. It's at 15 now, right? The little blue line here. You're just buying that when it goes over zero. And you're getting out when it crosses back down. This is somewhere around here. So in here, out here, right? You're in here. You probably got nicked here. Yep, minus 25, minus 12. But you're back in here. So out, back in, and you're still in on this trend. So both of, the idea is super simple on both of these. You're buying the crossover zero for the DMZ diff, and you're buying the actual line crossing over zero for CI. Now, the trade that a lot of people want to make using CI is often taking it oversold and then buying this cross up right here. So this would be the blue line over the white line, and then riding that up to the next cross. That's fine too. I find if you're going to trend follow, it works, in my opinion, it just works better if you're buying the cross over zero and under zero. And so I've got that marked with SPX. So if you're looking at SPX here, I've got the greens and the reds marked where you can see where the cross was down underneath zero. You missed that whole down move, right? You're back up here, chopped up, back in, chopped up. But this whole entire bunch of trading down here, even if you did all that and did it through the entire bear market, even though what you really should do is just stop trading once the weeklies roll over like this, you shouldn't even be fooling with anything with these crosses unless the weeklies are bullish, right? So like if we're talking BA, right, we don't want to be fooling with BA buying these crosses up if the weeklies are in a downtrend. We want to be doing this kind of stuff when the weeklies are in an uptrend. So if you're looking at BA, during this time period, let's say like starting in November, started going down, we don't want to be fooling with buying these crosses up only since October. So in other words, here, let's say like October 11/11. You could buy that, right? Now, it depends on, the stock and whatever you're looking at, but the idea is the same. We want to be buying these crosses up in stocks with options. Generally, I don't trade options. I think they're a ripoff, to be honest. Especially for some of them. But some of these liquid names are good. Like trading Netflix options is not terrible. Your issue trading options is you don't ever know how long this is going to last. And that's kind of the problem. So you might trade it up and say, oh, well, I'm going to buy monthlies now in June. June comes, we don't go anywhere for like a month. And now, your options are worthless here after a month. And you could have caught the whole move up, right? You have to be right on at the third variable of time. That's what makes trading options so incredibly difficult. They're better served, in my opinion, for either really, really, really long-term trading, like buying leaps, which you could do here. Like you could say, okay, I'm just going to buy a leap in November for BA and just let it ride till I wanted to cash it out. That would be like a leap would be like a year plus expiration. Or you probably would come down here and we can talk a little bit about trading really short term. And we'll do that here with SPX. So the setups here would be, these, and it's tough with options because you got to keep rolling them and you have to be right on that time variable, as opposed to just buying stock. All you have to do is hold on to it. And it can take a month, it can take a week, it can take 3 weeks, it can take 4 weeks. You never know. But what we can do if you're going to trade short term, what I like to do is these are the Hoppy CI diff dots, and you can program them at 5. You could program them really, whatever you wanted. Like if you edit, and I'm going to wrap up here in 5 minutes, and you edit this and you say you put it at like 3.5. You're going to get more trading opportunities. You see more dots appear, right? So the looser you hold those, the lower the number, the more dots appear. I wouldn't go any lower than 3.5 because you want to be selective with mean reversion trades. The prior two setups I've been talking about are not mean reversion. Let's just do this one like 4.5. So like if we do 4.5 here on the CI diff dots, what I like to do, if you're playing mean reversion, you're trying to play for a quick move back the other way. You're not worried about holding on to this for a month like you are up here. You're not worried about holding on to this for weeks and weeks and weeks and weeks and weeks like you are up here, right? So these would be trades that would last maybe 1 to 5 days. And right now, this is what I'm basically doing in this kind of market. It's a bear market. Trend is down, 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 down. We don't even have the CI over 0 yet on the dailies. So it's garbage there too. So the only thing you can really do is find these 1 to 2 day really oversold conditions and try to hold on for 1 to 2 day pop. What you can do in that case is it's pretty cheap to use, your weekly options for that kind of stuff. And especially on something like indices or like the sectors or like some of these really liquid names, up here, all these names have plenty of, like a pretty darn liquid options market. So like if I go into the daily setups, one of the things you can do is sort your CI diffs here, right? I don't think I have anything that's super oversold. The closest we have would be like UNH. You see? UNH here today is down 2.5%. It's minus 3.5, which is probably the lowest I would consider taking a mean reversion trade. But you can see what happens if you bought this day right here and you held it. And what I like to do is pretty simple, is buy when you see a dot and sell the next time you see the close of a bar get over the prior day's high. And that sounds a little convoluted, but it's pretty simple if you look at the chart. This, you buy, this is a losing trade, but let's say you bought it at the close because you saw the dot. You held through this garbage. This close is underneath this bar's high. so you're not selling. This close is underneath this bar's high, so you're not selling. This close, while it's up, did not go over this high, so you're holding. And here is where you got your first close right over this bar's high. So you're out here. You bought here, you're out here. That's that trade. It was a loser, right? No matter, and what you see is that, the next day it goes up and yeah, it's a winner. But this is a potential setup. It's not there yet, in my opinion. It would need maybe another day. But what I would do is I would take this radar list. This is just a daily list, and then I would do something like scan for anything greater than or equal to like 4.5 or something, right? And the only thing I got is overbought, like Target. And you say, oh, would you consider shorting Target? You could try shorting Target. This is what happened last time it got bars like this. It blew it apart. It's in a downtrend, right? The DMZ weeklies are down, but it's in an uptrend right now on the dailies, and it just started. So you'd say, well, I don't know. This would be one where I'd be like, I don't know, maybe not. PayPal. Look at PayPal. Looks like it's short squeezing today. Look how it's in an uptrend though in the weeklies. Obviously really, really, really big downtrend, but in an uptrend here, right? And here is the overbought conditions, right? Now you'd say, well, if I was going to short it, what would be a good way to short it? Well, the same rule could apply. If you shorted it here, this is the last setup, you would wait for the first close underneath the low of the bar. Short it here, wait. This close is not under this low. No, hold on. This close, it did not close underneath this low. You're holding on. Bing. There's your first close underneath the prior bar low. So you short it here, you're out here. And that's like a 3-day trade, like a couple percent. But if you have these, if you have a list of stocks that's like the S&P 100 and maybe some of the ETFs that are really popular, you'll be able to get more than enough trades during the week, to be able to do stuff like that. And the other thing you can do with these kind of setups, with these overbought and oversold conditions. Let's zoom back out just so you can see the bars and the overbought, oversold. See, you can see it goes up, but this day it's overbought and bing, bing, bing. You can get a quick trade to the downside. Here, oversold. It's in a downtrend, but bing, bing, bing. You can get a quick trade to the upside. Here you go. Here, quick trade to the upside. You would have probably bought it here on that first bar, sat through that one and gotten out on that bar because that's the first close over the high, but you still would have made a little bit. Here's the same way, short, and now we're setting up again for potential short. It's transitioning right now into a daily uptrend, so there's something to be said for that. But again, you're talking about really short-term things. It's nice to stack the odds against you with a downtrend and a downtrend and then an overbought. I love stacking those odds. I don't know if we can find one here. We might. Downtrend here, moving into an uptrend here, but still not bad. This is not a bad one. Whatever this is, USB, I think it's a bank. Capital One, downtrend, transitioning to an uptrend, another bank, another potential short. Target, we just went through that one, and then Verizon. Verizon's not super overbought. See this? It's not 6, 7, 8. Really big downtrend. Goodness, this is possibly a short squeeze. But again, these are just stuff that you can do, right? So we can. I think we can probably wrap it up with that. It's pretty simple. So I'll put it back on SPY so you can just to recap, the last 30 seconds here. Pretty simple rules. Buy when DMZ goes over 0, sell when it goes back under 0 for the weeklies. It works really good on the indexes. I actually trade this in my my long-term account's one of the models I like to use. So, and then this is same concept, just use the CI, and then you could trade trends in on the dailies. And there's all kinds of permutations you can use to, if you wanted to take half off when the CI got overbought up here, cut half your position and then take the other half off when it crossed over zero, you could do that too. There's nothing wrong with that. We day trade that way, where we'll take basically all of the thing off when it gets overbought. Or if you saw these magenta, what do you call them? Crosses, you can take some off. And then the third thing would be a mean reversion trade, where anytime you saw one of these dots, you'd buy, and then you'd wait for the first close after the prior day, first time to see a close over the prior day's high. And then, you're talking 1 to 2, 3 day pops. And it works really good in a bear market. It also works during a bull. You just don't get as many opportunities because you just don't get extremely oversold as much. But that's pretty much it. Pretty simple stuff. And it's not that difficult to do because of the rules. They're pretty hard rules. There's no ambiguity associated with it, and discretion. So I'm going to cut the recording down.